Welcome to the It's Your Smarter Money Show, where you will learn well to live well. Discover investing and financial planning strategies, ways to live your best life, insights from engaging experts, and much more. Now, please welcome your hosts.
Hello, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. And we wanted to talk a little bit today about risk and how come it matters so much. Over time, clients have tended to ask us, what's next? What's going to happen? And, especially with the stock market, is it going to go up? Is it going to go down? And this past week is no exception, especially after the election. People want to know what's going on. So we firstly want to just say sorry, but we have really the same answer that we give you every single time, which is our crystal ball is broken. We don't know, and we don't dare guess. We found that when we do try to guess, or anybody with any kind of hubris tries to guess, they can tend to be wrong. So instead, I just want to say it's been shown empirically that even the largest investors in the world with the best and the brightest portfolio managers have never been able to really outperform the market. In fact, the data has shown that they underperform. A recent study, Steve, I don't know, I haven't shared this study with you, but I don't know if you've seen it. It came out in the Journal of Portfolio Management in 2020. Richard Ennis published some research where he showed pension funds, endowments, educational endowments, all underperforming the market. And these are the people with tons of analysts, people from Harvard and Yale, and all, with a lot of information, still continue to underperform. So if we know that investment professionals will have a tendency to underperform, you probably are asking, why do we even hire you? Why do we want an investment manager? Well,
that's right.
The reason why you've hired us is to mitigate risk. Our job is to make sure that we have mitigated risk as much as possible so that you will stay invested, so that you will reap the benefits of patience of remaining in the market. And so that is what we want to talk about today, is how we have mitigated risk regardless of what happens.
Now, I just want to go back to something which was that study you mentioned, Laura, is very interesting. Now, we have a pretty sophisticated piece of software called Morningstar Direct that has some very advanced features in it. And one of the advanced features is the ability to look at active managers and see how many of them have actually beaten their benchmark. We can look at over different time periods, 5 years, 10 years, 15. And the further you go out in time, the fewer actually can beat or even match their benchmark, which really that backs up that study, which you just quoted, Laura. I haven't seen that study, and I'm going to definitely take a look at it.
Yeah, I mean, it's really fascinating.
Yep.
How we are unable to do that. There's just too many variables. It's kind of like guessing which way you're going to hit the golf ball, with the wind and the grass just all of that. It's just really, really difficult.
Well, I'll be very honest. 25 years ago, I was fooled into believing that you can choose some active managers and they may have the ability to beat the market, and, as you gain experience in this profession, you realize that really nobody can. And if they have beaten a market, it's really hard to prove that it was statistically that it was skill rather than just luck. And you find that in most cases, what appears to be skill trails off, and it looks more and more like luck in the long term.
Right.
So,
And so sometime at some point we should do a video about that piece. But we're very, very clear. Our job is to mitigate risk. And we know the best way to mitigate risk is using portfolio theory that has been documented over and over and time tested over many, many years, initiated by your favorite instructor at Rutgers, Steve Markowitz, right? Where he first came out with the concept of just having two different assets. When you combine, instead of just looking at one asset and just investing in that one asset, finding another asset that has a different pattern of behavior so that when you combine them, you get a smoother out return.
That's right. Yep. I just want to mention Dr. Markowitz was a wonderful man, by the way, and very good teacher, very, very good teacher. And I was really honored to have him as a professor,
Yep.
quite honestly.
And so this shows green and red, and by adding them together, we're getting a smoother return. And we have an
That's right.
exercise that actually gets into more detail on this, can actually help you understand.
Yeah.
I always like to ask people when they see this, I used to use this for my students
Okay.
all the time, which
Okay.
asset class would you prefer? The one that is producing the 12% return or the one that's producing the 10% return? And of course, everybody says, oh, clearly investment A. And I say, but wait a minute, what if we told you the details of what happened during year one and year two? And so once we show them that detail, they start wondering, well, gee, we see that A is a little bit more volatile than B. So not necessarily sure, but I still think I want to go with the A because it has a 12% average return.
That's right.
And so what we did was we took A and B. We said we're going to invest $100,000 in each one, or we're going to invest in a portfolio that includes both of them together. And we said $100,000 in investment A produced $111,000, but investment B is $117,000. And
Right.
so just looking at that, wait a minute, A, even with its 12% average return, has less dollars at the end of this. Well, why? I mean, you could visually look at this and see that clearly A is much more volatile where it went high and then low versus B that's a little bit less volatile. The volatility matters.
That's right. Yep. And this is, most people are well aware of the powerful effect of compounding, but it really works against you if you have a volatile asset class compounding. And that's the string chain of returns from one, time period to the next, a year, from 1 year to the next, for example.
And this is the combined portfolio, right? So this is
That's right.
because when you look at A and B, they are moving in opposite directions in year one and in year two. And so by combining them, we have a smoother portfolio and we actually get more money at the end. Now, most people, even investment professionals, use average arithmetic returns and they do an average mean and they come up with this 12%, 10%, 11% that you see on this page in terms of the returns. But that's not correct. You have to
Right.
take into account compounding, as Steve just said. And when you do that, you'll calculate a whole different type of return. They call it a geometric return. I did the calculations quickly, and the A has a geometric return of 5.4%. B has a geometric return of 8.2%, and AB has a geometric return of 10.4%. That's the right number to be looking at, is that the geometric return. Nobody knows how to calculate that, and so most people don't really look at that.
And I don't want to mention another important aspect of this. You see the smooth return because of the combination. And Laura's going to mention and probably pretty soon why that return is so smooth in relation. But there's another aspect to this, a behavioral aspect. So if you were to invest in, for example, choice A, right, and we all have this fault in our brains. When you start to see that investment go up like that, you'd probably say, "Gee, maybe I should put more money into it." Or if you look at investment B, you say, "Gee, the market was up, investment A was up, but B was down." So you might decide to, if you held B, let me just sell it. Because of that, the wide variation in returns each year of those two investments, you may make decisions that are bad decisions based on the behavioral faults that we all have. Whereas the combination, quite honestly, you're less likely to make a bad decision because that return is so much smoother, quite honestly.
Mhm. Mhm. Yes, so mathematically, it makes sense to do this, and also to keep ourselves properly invested, it makes sense.
That's right.
We have two examples here to share with you on the concept of geometric return. Another term that they use is compounded annual growth rate. Either one works, but this is just an example where if you have $1 million and you invested it and you lost 50%, and so now you have $500,000 at the end of the year. Well, first of all, you'd be very, very upset. But of
Yeah.
course, we would say, stay invested. You chose to take that risky investment, stay invested. But even if that $500,000 went up 50%, which the average return in theory is zero, if you took the 2 years, you would still not have the, I'm sorry, the brackets are wrong. You would have 750,000 at the end of that 2 years. Now,
Right.
you might ask, well, what is the return? Because people will say it went down 50, it went up 50, I'm whole. But no, you're not. You're still down by $250,000. The geometric return is still negative. The second
Yes.
example is one that really happened to somebody. They came in and they had $1 million that they had gotten from proceeds from selling a house. They plugged it into some very aggressive technology stocks, and they had a great return the first year of 80%. And they said, oh, look at this. I'm doing wonderful. So they wound up with $1.8 million. They left it for the following year, and that was a correction in 2022. They had a 50% reduction. And so 1.8 halved, ended up with 900,000. Now,
Yeah.
the woman that came in she just couldn't figure it out. She's like, I don't understand. I went up 80, I went down 50. I should still be ahead of the game, right? I still have an average return that was
That's right.
15% ahead. But no, the compounded annual growth rate, or that geometric return, was negative because you started out with $1 million and you now only have $900,000. And so this is what we're
Yep.
trying to prevent, is we're trying to prevent this mathematical problem, and we're also trying to prevent the behavioral problem of people jumping in and out of the market at all the wrong times.
Now, I want to mention too, this can happen especially with a highly concentrated stock position in particular, or if you choose one, very aggressive sector like technology. But if you have a really well diversified portfolio, it actually behooves you to ignore this, even if it drops by 50%, because the odds of you recovering and gaining your money back are much, much, much higher than if you were not adequately diversified.
We have seen the US stock market go
Yeah.
down by 50% a couple of
Right.
times. We experienced that back in 2007 through 2009, where the US stock market went down by 55%. And a diversified portfolio, you shouldn't actually see that. And that's what we're trying to do, is trying to stay invested, because we don't know what's going to happen. We're not going to jerk the money out and in and out and in. We're going to remain invested in an all-weather strategy that can ride
That's right.
volatility.
At the very least, if you want to have all equity, at least be diversified within it. And even though you may be down 50%, you will recover if you have the S&P 500 index, for example.
Yes,
But you should do that, right?
Yes, that is at least 500 of the top companies in
Right.
the country, but it doesn't include small cap, and it doesn't
Nope.
include international, and it doesn't include a
Nope.
lot of other diversifiers that would have helped you in some years.
Yeah, and we're certainly not recommending that. What we're recommending is what Laura just said, to have all these various asset classes in it, because the odds of you recovering and the odds of you recovering more quickly are far higher, besides the point that you probably won't even go down as much as any of the individual asset classes.
Yeah, unfortunately, a lot of folks, even back in 2000, when they came in and they said, oh, I was diversified, I had this technology fund and I had that technology fund, and they were just down, some of them like 60% down because of all
Oh, yeah.
the holding.
Yes.
And we had to show them that, no, you weren't really that diversified. You were only in one sector. And so,
Well, do you remember, Laura, when the NASDAQ was down about 95% from its peak at the
yeah,
beginning of the internet craze?
yeah.
Right? That's a
Yeah.
prime
And
example.
it didn't come back till 2015. It didn't come back
There
for
you go.
years,
That's right.
including
Yeah.
Microsoft.
Yep. Yes, that's correct.
This is an interesting chart because it goes back to 1872.
I remember that year. It was a good year, by the way.
It includes the returns over that period of time, both positive and negative. We had a client recently asking us, well, what has been the average return over the long run? And so we showed them this chart, and we said, this is a net of inflation. Really, you want to look at the geometric mean, which shows that a good solid return over the long run is 7% net of inflation, or real
return, yes, above inflation, right?
This shows the distribution over that same period of time, where 30% of those years from 1872 to 2023 have been negative. And it's eye-opening to see that, and recognize that there are years that we do experience negative returns.
On average, each decade, you have 3 bad years, right? Effectively.
That's right.
Although we have seen in an entire rolling 10-year period where the market was down as a whole, from 1999 to 2009, the S&P return was somewhat around minus 6% total for that 10-year period, which proves that you need to be really diversified by asset class, because over that 10-year period, there were plenty of asset classes that actually did perform well. And the S&P was one of the losers for that time period, whereas REITs
International
performed.
did well, small cap did well.
International.
It seems like it flips then the following decade from like
Yes.
2000 to 2020, where it was the US market did quite well and the others didn't do as well. But it's important to keep in mind that as we start looking at large numbers and that things start to gel, and they call it reversion to the mean. They start
That's right.
closer together. And so if we just had a whole long period of time of really positive returns for the US stock market, the question that is always in statistically minded people is, will that continue, or will there have to be some kind of correction? Because we know that nothing goes to the sky.
No, that's correct.
This is what you were just talking about, Steve. This chart shows the S&P 500 from 2000 to 2010, which is the blue line. It shows that it went down, it went up, it went down, it went up. And if you just stayed there and didn't sell, you would have wound up with the same money that you started with, which would have been fine, but that's not what a lot of people did. Overlaying this chart are cash flows coming into the US stock market and cash flows going out of the US stock market. And you can see that a lot of people sold at the bottom of 2010 too, and at the bottom of 2008-9. And that's unfortunate because you're locking in those losses. And this is what we want to prevent. And that's why we need to control the risk.
Also, look at the delayed reaction. There were still people in 2000, after 2008, that were still selling out of the S&P, even as it was starting to go up.
Yeah.
For some reason, they may not have sensed that the market was recovering, and they were still selling. It's crazy. Yeah. This effect's called herding, by the way.
That's right. And just so you're going to define herd, it's when everybody
like a herd of cows.
And we see that behavior a lot in the world of investing.
And it's another psychological aspect or behavioral aspect that most of us have. It has to do with the way our brains are wired. What happens? We tend to there's a part of our brain that makes us react in a real fast way before other parts of our brain that tends to think, or I should say, evaluate the decision through time react. So it's for example, when you put your finger on a hot stove, you're going to immediately react by pulling your hand back quick. You have to, because otherwise you get burned. And so people react that way to the market decline. But if they took a step back, the other part of their brain, which is a more rational part of their brain, would start to kick in, and they would start to realize, gee, I need to think about this better before I make this decision. But that's what happens, and it's how we're wired. We have to fight it.
In 2008 felt to go running, and fortunately we all have this discipline strategy, and we documented exactly what we're going to do in the investment policy statement, and it does not say sell at the bottom. We believe strongly in the discipline, and when you come back to us and ask us to change the level of risk in your portfolio, we ask you to sign something that's not necessarily a requirement, but because we want to create that discipline as opposed to being an emotional reaction, like lifting your hand from the stove.
And keep in mind, you're relying on our 30 years of experience. So we've been through, personally, Laura and I've been through probably 7 or 8 bad markets already. So we have years of experience to understand better the mistakes that that can be made, and also the right way to do things. Because we've been through it, we understand it well.
And also all the documentation that's been published in the
That's right. That's
scientific
right.
journals have supported that as well.
That's right.
This was an interesting chart that was published by Morningstar that we wanted to include because it shows just a short period of time from 2007 to 2023. And on the left-hand side, the actual performance of the S&P 500 over time. And then it shows having more disciplined strategy that is less associated with risk and cutting off some of the high highs and low lows when we do asset allocation. And coincidentally, you see, instead of being down 55%, we're only down 41%. But then instead of being up 529%, we're only up 397%. So, we're cutting off the highs and the lows, but we wind up with the same money at the end. Actually, even a little bit more money on the right-hand side.
That's right. Yeah. And as humans, that's easier for us to withstand too, because we're less likely to have that fight or flight effect. And because when we see a much smoother portfolio, but on the other hand, and we've seen this, people say, "Gee, how come you're not going up as much as the market?"
Right. Well, that's the biggest thing that we talk about, Steve, is
Yes.
because they call that tracking error, where you're not actually, what people watching on TV is not necessarily what you're experiencing.
That's
And
right.
it is a concern that there's a little bit of a disconnect, but as people start understanding more and more what we're doing and they get it, they start seeing the actual results. I think they get more comfortable with not actually tracking the S&P 500, especially when the S&P 500 is down, for example, in 2022 by,
Right.
you know,
Almost 20%.
18%. Yeah, right. And they're not seeing that in their portfolio. Then they say, "Oh, I
Right.
get it."
That's right. And keep in mind the risk level and the return level that we've tried to target is really tailored to your needs and goals anyway. So you may not have to earn 12% a year to meet your goals. If you do have to earn 12% a year to meet your goals, maybe your goals need to change. But the risk level that we've identified is that makes the most sense for you is based on your risk tolerance, as we said, and also your goals. And so.
Yeah, 12% is, by the way, beyond investing in the S&P 500. That's
That's
like
small
you have to
cap.
be truly, truly out there,
Yeah.
very, very risky.
Yep.
And yeah, okay.
Or some, non-public investments, and even those. I mean, there's so much risk that can't even be identified with a lot of them. So,
Right.
okay.
Okay. So, there wasn't that other slide. So there was another slide that I thought we added that did not, I guess, show up for some reason on here, which it showed returns over 1 year period. It was my favorite slide, Steve.
I know it's not in here for some reason. We
Period 1872 to 2023. It showed 1 year, how many years it's down. And then it showed a rolling 5 years, how many years it was down. A rolling 10 years, how many years it was down. And then a rolling 20 years, how many years it was down. But even with the rolling 20 years, it was never down in any 20-year period. But there were some
no,
years where it was barely like just so for 20 years, it barely made anything. Back in
very low
the 50s,
return.
for example,
Yeah,
where it hardly did anything. And so one of the things that I was actually thinking about when I looked at that result was that that data that is on that chart is what Jeremy Siegel used for his book Stocks for the Long Run. And he talks about the fact that stocks are only risky if you are invested for the short run. Well, nobody
that's right.
invested for 150 years. That's crazy. When people think long run, they are thinking about 20-year, maybe
That's
30
right.
chunks. Yeah, for the younger people, like the 30-year-olds and the 40-year-olds, if you want to invest just in the stock market and ride it and perhaps go through a 20-year period where you don't have any returns whatsoever, then you could. But for the person that is retired, you're not going to stomach that. And to top it
No,
off, the sequence of those returns. Yeah, he wasn't considering the sequence of the returns, which is something we didn't even address here, but probably should do a whole video on itself, because it
Yes.
matters how the returns over that next 20 years occur. So if you actually retired at, in 1973 or in 2000, and you watched an immediate dive that and you were taking cash out, you
Right. That's the
usually
key. Taking
never,
money out in
ever
different.
recuperated from that.
Right.
And that's a big concern as well. So,
There's a simple way to look at that. And, everybody always talks about how dollar cost averaging helps you. That's reverse dollar cost averaging, because in dollar cost averaging, you're adding money into the market on a regular basis. So when the market's down, you're basically buying shares at a discount. But if you're pulling money out, the exact opposite happens. You're selling shares at a discount. And guess what? Those shares you sold at a discount, they don't have the opportunity to take part in the recovery. And so the order of return makes a big difference when you first retire. So if the market declines immediately when you retire, if you're, for example, using a 4% withdrawal rate, I'm not saying it's a good rate or not. I'm not talking about that here. But suddenly the market goes down by 20%. Suddenly your withdrawal rate is 6% or 7%. And so you pulled 7% of your portfolio out. That's a significant part of it. So that's 2 or 3% less that could recover. So you may never recover is what ends up happening. You may run out of money in 20 years as opposed to have your money last for 35. So
right. And even just it being flat, there were a couple instances where the 20-year return was almost flat. And that's what the
I
Japanese
know of one,
did.
right? From 1966 to,
Yep,
it isn't quite 20, but it's probably close to it, to like
yep,
1981 or 82.
yeah,
I know, I always remember, because vividly, they kept saying the Dow, the big benchmark for the Dow was, will it ever go above 1,000? And it took
right,
forever for it to go above
right,
1,000.
right,
And it actually didn't cross 1,000 and stay above it until Reagan's administration. And when it touched it was during the Johnson administration, believe it or not. I think it was 1966, I think, and dropped back below it and never went above it. And in that space of time, there were a couple of really bad bear markets. I remember, I think 72 to 74, the S&P was down about 50%. Times of high inflation, slow growth in the economy, what they call stagflation, which, by the way, Milton Friedman predicted that effect. He was one of the few. But so there were some bad periods. But this is less likely to happen if you don't just have large cap domestic stocks. That's the key.
right, right. And but I guess the reason why we decided to do this video and this topic right now was because of the question that we've been asked about the results of the election last week, and what was our feeling, or what did we think? And we really don't know. I mean, there are,
No.
for example, when Reagan got into office, the PE ratio back then was 8. And so there was a lot of,
Laura, at one point in the 70s, it was 6.
okay, but he had a lot of room to run.
He
Right now, the
did.
P
Yeah.
ratio, I don't know, is it 27 or so? It's something crazy.
Yes.
So the
Yep.
run rate is like, there's a limit to how much it can run, regardless of what you think.
Right.
We think that there might be some opportunity tailwinds for maybe small cap stock and private equity in areas where less regulation and potentially also lower interest rates could potentially benefit those areas. We're
Yep.
not taking bets on those pieces.
No.
We know that there's always going to be something that's performing in our portfolio and something that's not performing in our portfolio. Back in 2022, we had 4 asset classes that were actually positive, and one of them very, very positive. And that was,
Natural resources.
back in 2008, we had asset classes, actually mostly our bonds, that were positive. But we always have something that's performing. So
That's right.
that's what we're doing, is we're managing risk for you.
That's correct. Yep.
So hopefully this is helpful. If you want to have any further conversation about this, you know that we're always available to meet, to talk on the phone, whatever you'd like to do. If you have any other suggestions on what you would like to hear from us, please let us know. Some of the topics that actually just came out of the peripheral of aspect of this conversation, we might talk further about, like concentrated stock and
Yes.
sequence risk and all those things. We should do more videos on those too. So
Yes. They're important concepts.
yes. So thank you for listening, and Until we see you again. Bye.
Thanks for listening to the It's Your Smarter Money Show. If you found this episode valuable, please like and subscribe to our channel. Until next time, learn well, live well, since, after all, it's your smarter money. Thanks for tuning in, and we'll catch you in the next episode.